Hello everyone, how's it going? In this video, we will talk about Schwab US Dividend ETF trading under the ticker symbol SCHD. The SCHD ETF has been a very popular one for retail investors to follow in the market because it offers a very high yield with low exposure, along with very reasonable fees for a very diversified portfolio in one click. As we know, over the past few years, the job market has been looking more uncertain than ever before, while inflation has been melting people's saving away in economies that used to be deflationary not that long ago. When so many certainties can melt into nothingness in a heartbeat, it is very crucial for us to create a better financial future for ourselves. In order to secure our own financial future, that is, we absolutely need to find stable revenue streams that can distribute dividends to shield us from the volatile stock market. For many, the SCHD has always been one of those opportunities. Beyond just another dividend ETF, it is often seen by the retail and institutional investors alike as a safe haven, capable of delivering stable and growing dividends. As one of the biggest and most diversified dividend ETFs in the market, the SCHD has remained a very popular choice to follow. In this video, we will take a deep dive into SCHD and to see whether it deserves to have a place in your portfolio. So, before today's video continues, if you want to watch more stock analysis videos like this one, as well as for many other companies, please check my channel for more and to subscribe to stay updated to the latest. With that being said, let's start with today's topic. So when I look at the stock chart of SCHD, what I'm seeing right now is that over the short-term period of time, things are more or less touching a ceiling around the $77. Now, over the past 6 months, then I would say that things are mostly stable with a bottom touched around $66.90, and then it has risen by around 15%. However, if we look at where, the past 6 months have begun, then the increase is around 3%. So over 1 year, it's about the same thing. In fact, it has decreased by about 1%. Over the past 5 years, it's mostly stable ever since 2021, but before that, of course, the price action were a lot lower, and over the maximum period of time, it would be seen that SCHD has enjoyed continued increase, but I would say that this increase over the past few years is not really visible because things have risen by so much. Especially since the dip of March 2020. As you remember, as the world went from the normal state into an economy of shutdowns, it really dipped by a huge cliff at around $40 in March 2020, and then it has climbed back very quickly. I think that there was a little bit of a artificial euphoria in the air during that period of time, and also because retails overall have become more aware of the stock market. Maybe the meme stocks as well as Tesla, funny enough, have definitely helped the popularity of many equities and ETFs alike. So as we speak, the options market indicates the strike prices between $77 and $78, which are significant because they're mostly call options. This implies that there is a notable interest and activity around those prices for SCHD, assuming that the price of this ETF in particular will be able to increase and continue to do so. So, options do play a crucial role in trading stocks. They provide the investors with the flexibility and the risk management strategies that are often required. Calls and puts allow traders to speculate on the future price movements of the underlying assets. In the case of SCHD, calls with strike prices between the $77 and $78 are a way for investors to capitalize on the potential upward movement. Volume is also another key metric to look at in equity trading. And in the case of SCHD, its recent volume has been around 3.3 million shares compared to the average of around 3.7. The stability in the trading volume is definitely a positive sign. It indicates a sustained level of investors' interest. The volume is crucial because it reflects the level of activity and liquidity in the market. Higher volume often suggests that increased market participation, providing traders with more opportunities to buy and sell in the desired prices, continue to exist. So, given the current situation, I would say that if we have seen a pretty soft price action performance over the past few days, it can definitely be explained by SCHD's trading volume. Now, what can explain this trading volume is everybody's guess, but mine is that so as the expectation for interest rate cut has been increasing over the past few weeks, the risk appetite of capital might be increasing once again. This has been coupled by the fact that Palantir has released some very strong fundamentals, so maybe a lot of people who previously have been playing safe are now looking to get risky once again. But we don't really have to worry about these, because having a lot of gains or having a lot of growth opportunities is not exactly what SCHD is here for. Overall, it remains in a strong market position, reflecting the stability amidst a market that lacks clear direction. The sideways movement could also be attributed to ETF's own resilience and the consistent performance. Considering the recent trends, options activity, and trading volume, I believe that this current juncture is pretty ripe for entering. The ETF has been lingering at around the $70 to $75 range over the past few years, and that represents about 0.5 to 1% increase. Let's also broaden our view, with that being said, and talk about the overall picture. So, the ETF has been maintaining a sideways course, and 2024 appears to be following a pretty similar trajectory, showing minimal change. However, there are a lot of buzz in the air suggesting substantial movement changes. So because of this, we're cautiously optimistic. With an expense ratio of approximately 0.06%, it's a very cheap ticket to have in one touch over 100 US stocks. The prominent names like AbbVie, Texas Instruments, Broadcom, and all are really all part of the mix. Essentially, it's an investment into the strongest part of the American economy without the hassle of managing individual stocks. But with that being said, what about the yield? What about the dividends? SCHD has that aspect covered as well, and in this scenario where the inflation is making its presence felt, SCHD is offering around 4% yield. And remember, this yield in the absolute sense tends to increase over time. So, to answer the question why is SCHD so popular is because it's a preferred choice amongst both seasoned investors and everyday people like us. With the expectations of interest rates undergoing their own fluctuations, SCHD might be gearing up for an exciting journey. So I would say that we got to be very vigilant going forward, as we will be entering into some interesting market volume. So right now, the global markets are facing a complex interplay of factors that have the potential to significantly influence the equities worldwide. In this speculative analysis, I believe that the consequences of the global inflation, surging commodity prices, and declined quantitative easing, as well as the rise of inflation rates or interest rates, plus the geopolitical instabilities, are going to play a significant part The increasing inflation rate has been putting pressures across the globe, threatening the purchasing power, raising the input costs, and impacting corporate profitability. Companies operating internationally may face challenges in managing rising production costs and also to sustain profit margins. Those dynamics could trigger market volatility as investors adjust their risk-return expectations. The upward trajectory of commodity prices, including energy, metals, agricultural products, have been having far-reaching implications for various sectors of the global equities market. The companies heavily dependent on these commodities may experience squeezed profit margins, potentially affecting stock valuations and investor sentiment. The reduction or the end of QE's quantitative easing measures by the central banks worldwide may have resulted in reduced market liquidity. So this in turn could lead to higher borrowing costs for companies seeking capital, which may also discourage investment activities or will. The elevated market volatility plus the reduced investors' appetite may also continue to occur. Now, the central banks around the world are tackling this delicate situation of balancing the inflation rates with the economic stability and, if possible, growth. Central banks opted for aggressive interest rate hikes to combat inflation. Borrowing costs for companies have been rising, which has also slowed down business activities and also fueling the market's volatility in terms of the equity prices. Now, ongoing geopolitical tensions, including trade disputes, political uncertainties, and social unrests, will inject an additional element of volatility into the global markets. Investors may adopt a cautious approach, shifting towards safer assets, impacting the equities. Additionally, the escalating conflicts may disrupt supply chains, negatively impacting the performance of international companies. Given the interconnectedness of global markets, the aforementioned factors have reverberating effects on the US equities market. Companies with significant exposure to international market may face a lot of headwinds resulting from the economic slowdowns, disrupting the supply chains and the currency fluctuations. But nevertheless, the US market is known for its resilience, and the diverse sectors may attract investors seeking safe havens. So really, the current landscape is characterized by global inflation, surging commodity prices, reduced quantitative easing, rising central bank inflation rates, geopolitical instabilities, and also ongoing lack of certainty regarding growth. While the US market may exhibit relative strength due to the safe haven status, it's going to remain interconnected with the global economic landscape. For long-term investors, these conditions may offer opportunities to identify undervalued companies with strong fundamentals and international diversification. With that being said, short-term trades should be approached with caution because of the increased volatility and uncertainty. And also, we should be careful when assessing individual companies, sectors, or regions. With that being said, given how things currently stand, I would recommend to gradually build a position in SCHD over an extended period of time. This potential decrease in interest rate could instill a renewed sense of confidence in equities in general, but not necessarily in SCHD. In other words, we might see some healthy pullback from the price action of SCHD over the next few months. This remains a possibility, but I wouldn't say that it's a certainty. Exercising caution is obviously essential given the currently elevated levels of the market, not just for SCHD, but for everything else as well. Despite the fluctuations that are to be predicted, I personally believe that SCHD is a must-have for most portfolios.